All right, let's talk about swing trading. We're going to break down a single trade piece by piece to see how it works. The goal here is to learn how to look at the market, not day by day, but, well, swing by swing.
I mean, really think about that for a second. All the little up and down ticks, the constant news chatter. What if you could just filter all of that out and see what the market is actually trying to do? Well, that's the whole idea behind swing trading.
So what is it? It's kind of the sweet spot in trading. You're not a day trader, glued to the screen all day, and you're not a long-term investor who buys and holds for years. You're a strategist. You're trying to catch one big, significant move in the price, a swing that plays out over a few days, maybe a couple of weeks. Okay, to really get this, we're going to walk through a trade from start to finish. We'll follow a trader's game plan, and it all begins with understanding the market's current direction. In this case, we're looking at a nice, clear uptrend. The trend is everything. It's the current that you're trying to swim with, not against. And an uptrend has a super specific signature. You're looking for a pattern of peaks that are higher than the last ones, and valleys, or lows, that are also higher than the last ones. Higher highs, higher lows. Simple as that.
And that's exactly what our trader spots on their daily chart. The pattern is just crystal clear. A peak, then a higher low, then another higher peak. It's like a staircase going up. This tells them that right now, the buyers are in charge. The scene is officially set.
Now, if the trend is the river, think of support and resistance as the riverbanks. Support is like a floor, a price level where buyers seem to show up and push the price back up. Resistance is the ceiling, where sellers tend to step in. These zones are the landmarks on our map. So here's the key. Our trader saw a previous peak, a ceiling, that the stock finally broke through. And a classic rule of thumb in trading is that an old ceiling often becomes a new floor. So that exact price area, it's now on their radar as a potential launch pad. All right, so the trend is up. We've marked our key level on the chart. Now for the hardest part, doing nothing. We have to be patient. We're not going to chase the price way up here. We're going to wait for the opportunity to come to us. And that opportunity is called the pullback. See, in a healthy uptrend, a stock doesn't just shoot up in a straight line. It has to breathe. It takes a couple steps forward, then one step back. That one step back is the pullback. And for a smart swing trader, that dip isn't scary. It's the opportunity to get in at a better price. And look at that. Right on cue, our stock starts to dip, heading right for that support zone we were watching. But here's a really important clue. As the price is dropping, the volume, the number of shares trading hands, is also drying up. This suggests the selling is weak, like it's running out of steam. For our trader, this is the light turning green. Okay, the price has arrived at our spot. The conditions look good. But a pro doesn't just click buy. Nope, they make a plan. This is the moment we turn all this observation into a concrete, rules-based strategy that keeps emotion out of the driver's seat. Before we do anything, we need to know exactly where our idea is proven wrong. That's the swing low. It's the absolute bottom point of this little pullback. If the price breaks below that level, the uptrend pattern is broken and we need to be out of the trade, no questions asked. It's our line in the sand. So here it is, the whole plan on a platter. The entry, right here, near our support zone. The stop loss, that's our safety net, placed just underneath that swing low. And the target, we're aiming for the price to get back on its horse and ride up to at least retest its old high. Entry, stop, and target, all figured out before putting any money on the line. And this is why we plan. It lets us do some simple math called the risk-to-reward ratio. It basically asks, for every $1 I'm risking on this trade, how many dollars do I realistically stand to make if I'm right? And we're always looking for setups where the potential reward is much bigger than the risk. Let's put some numbers to our scenario. Our trader gets in around $102. Their stop is at 99. So their risk is $3 per share. The target is the old high up at 108. Which means the potential reward is $6 per share. So what's the ratio? They're risking 3 to make 6. That's a 1-to-2 risk to reward. That is a professional setup. So what we just walked through, that wasn't luck or a random guess. It was a repeatable system. It's a workflow that you can use to break down a really complex market into a series of simple, manageable steps. Let's recap that journey. So here it is, the 5-step process. 1. Identify the trend. That was our traders seeing those higher highs and lows. 2. Mark your key zones. That was the old ceiling becoming the new floor. 3. Wait patiently for the pullback to your zone. 4. Define the entire plan, your entry, your stop, your target, before you ever get in. And 5, the big one, manage the trade based on those rules, not on how you're feeling.
This quote really just says it all, doesn't it? It's not about being right every single time. It's about setting up your trades so that when you are right, you make a nice chunky gain. And when you're wrong, you only take a small, predefined hit.
The mechanics, they're pretty straightforward. The workflow is logical. But, having a plan on paper is one thing. Actually sticking to it when your money is fluctuating is a whole different ballgame. Which leads to the real question, right? Once you have the perfect plan, is the hardest part just getting out of your own way and executing it? Something to think about.